Africa's infrastructure gap is an investment opportunity. In 2009, a World Bank report revealed that Africa required 93 billion US dollars per year to meet demand for adequate infrastructure. This figure has become part of the infrastructure debate, both in terms of the challenge it poses and the opportunity for investment it represents. Important progress has been made and infrastructure investment has reached record levels in recent years. But there are still significant challenges. 7 years on, less than half of the 93 billion US dollars annual requirement is being met by existing sources. Furthermore, the limitation of rising funds from multilateral institutions are beginning to show. While China has scaled back funding due to the slowing of its own economy, this presents a significant opportunity for international financiers to play a larger role in plugging the infrastructure gap, but only if they can locate bankable projects and navigate the inherent risk involved. Number 1, mitigating risk. Early identification and management of the key risk can be the difference between a successful project and unforeseen delays and costs. Risk, especially relevant to projects in Africa, include the following. Political risk. These risks arise from the action or inaction of central or local governments and include policy or regulatory changes that occur during the life of the project. These changes can adversely impact upon both the risk profile and or financial returns of the project. Many countries have complex overlapping consent processes which can involve various ministries and elongated time frames. Number 2, land issues. Land ownership in many parts of Africa is complex and unclear. Land acquisitions can be a slow process, and it is common for unregulated third-party claims to emerge during the acquisition process. Number 3, local legal issues. A clear understanding of local legal issues relevant to the project is essential. Each jurisdiction will have different legal requirements that will impact upon the structuring of a project. These can include a requirement that all insurances are placed in the local market before being reinsured, or a statutory cap on the level of interest that an investor can charge on any facility. Investors will also need to consider their ability to enforce their contractual positions under the relevant local legislations. The best way to manage these risks is that investors need to ensure that projects are structured thoroughly so as to be bankable before significant expedition is committed. This will involve the input of both an international law firm with experience of structuring complex infrastructure projects and local councils. Successful coordination between these two firms is essential. It is critical to consider how a project will be funded and possible funding sources at an early stage. Affordable funding is often a key factor in determining whether or not a project can proceed, and infrastructure assets often require long-term flexible funding solutions matched to the lifespan of the assets itself. Potential funding options should be explored prior to committing to a contract structure and supplier. It can be possible to unlock export funding options, but this will depend on the country sourcing of the supplier and often requires government support. An advisor with experience of raising funding for African projects is a key asset to a sponsor who is looking to ensure that the necessary building blocks for a project are in place or can be made available so that the most attractive funding is secured. By avoiding common mistakes such as not investigating the level of government support available to a project, failing to seek early advice on a project's funding options, or not understanding the structural requirements of potential sources of capital, sponsors will be in a good position to secure funding for infrastructure projects in Africa. African agricultural sector continues to draw high interest from investors. The trade and investment landscape in Africa has continued to draw interest from lenders, particularly in West Africa, with notable changes in origination strategies. In quarter 1 of 2021, Orbit reported a 26% increase in the number of unique inquiries from lenders originating funding opportunities when compared with the same period in 2020. Some lenders have seemingly decided to focus more on particular regions and in some cases individual countries, citing due diligence processes disrupted due to travel restrictions as a main reason and risk mitigation strategies as the second most common reason. These have prompted lenders to focus on regions and or countries where they have representative offices or a deep and reliable network. Agriculture remains the sector with the most interest, present in almost 70% of investor mandates. Financial services and manufacturing, including FMCG, are also quite prominent, being flagged as sectors of interest in 64% and 44% of investor mandates respectively. 231 unique lender inquiries were recorded in quarter 1 of 2021. Of these, 58% of the companies are either headquartered in West Africa or have their main operations in West Africa. 17% are based in East Africa and 16% are based in Southern Africa. Only 5% of these companies have cross-regional operations compared to 14% recorded in quarter 1 of 2020 pre-pandemic. A considerable portion of the lenders' inquiries included a working capital component in the proposed transaction structure, 35%. Supply chain finance and asset financing components were also notably present in discussions, 34 and 30% respectively. This quarter, the average ticket size was recorded at $12 million, an increase from the $10 million average recorded in the same time period in 2020. 20% of the companies receiving inquiries from lenders reported annual revenues between $100 million and $250 million, and a further 13% reported annual revenues of about $250 to $500 million, showing lender appetite for the larger companies. However, a considerable amount of inquiries were received by companies reporting annual revenues between $1 and $5 million, particularly from the more impact-focused lenders. The Orbit perspective. Africa-focused lenders may have adjusted their origination strategies this year, with international lenders working around travel restrictions and disruptions to due diligence processes. But activity on the continent continues to increase. Lenders are considering larger transactions and employing additional credit enhancements to mitigate perceived risk in transactions.